Welcome to the March Investor Advisory Review, where we take a look at ideas and concepts and strategies for creating, growing, protecting, and preserving your family's wealth in today's economy. We have a little larger group than normal. I think it's probably because people are concerned about some things, so we're going to hopefully be able to answer those questions, help you understand what we see, and give you some confidence as we go forward here. As always, we have the opportunity to remind you of the important disclosures that we think are critical for you to remember. It has to do with choosing investments wisely, understanding your risk versus your reward, understanding tax issues and legal issues, and recognizing that while we try our very best here to get you the answers to everything, we're not experts in everything. So sometimes you have to talk with your accountant to confirm tax issues and your attorney to confirm legal issues, and where our recommendation is always the same. Get a team of people who will help you think through things, and we will do our very best to support you in that process and bring new and interesting information to that discussion. One other disclosure I'm going to put on to tonight's presentation is in this program, I'm going to tell you that I don't have the answers for everything that's going on tonight as well. A lot of times I'll have a lot of information that provides a fair amount of answers, but in doing all of the research I've done for the last 7 days, just pulling together information, I'm going to tell you up front, I don't know that anybody really has all of the answers, but taking time to make sure we have good information, that we have understanding of what we need to do, and that we can make wise choices is the best we can do. And I'm doing the same thing this evening with you. So I, as always, am open to your questions, your thoughts, and your ideas on what we should go forward with as well. I will, however, give you the benefit of everything that I have gleaned over the last 7 days, so that hopefully together we can make some great decisions. There will be a time for questions and answers at the end. Probably I will save everything to the end for questions. This might not be as long as normal because we're going to be really just focused more on what's happened in the last 7 days or so with the bank collapses and closures and what that might mean both now and in the future for where we are with the economy and the markets. But we're going to save the questions till the end, so that way maybe once I go through everything with you, that may have answered some questions or maybe created some more, and we'll be happy to go through that as well. The goal tonight is to take a quick look at the market and economic review, to look at the impact of Silicon Valley Bank and Signature Bank's collapse on the US banking system and the economy, remind you of some of the strategies for creating, growing, protecting, and preserving wealth in a challenging economic environment, how we go forward here, reminding you also of the website and the various applications we supply you with so that you can review what's going on and have a great understanding and oversight of where you are today and where that's taking you into the future. I'll close off with some final thoughts. We'll take time for questions and then remind you of when the next advisory review is coming along. When we take a look at the primary engines of the economic growth of America, again, we're still looking with the GDP numbers. I'll talk with you about what we're anticipating for this quarter. Business profitability still is kind of up and down, depends upon the industry, depends upon how they're handling certain aspects of the industry, but still businesses are coming in profitable. That's why the markets haven't sank more than they have, and I think you'll be pleasantly surprised when we see what's happening in the last few days. But business profitability still seems to be pretty reasonable at this point. Unemployment rates are still in good territory. We're still pleased with those numbers, and even with some of the layoffs in the tech industry and maybe some of the subsequent problems that'll come out of that, it still looks like it's going to be okay in that area. And interest rates, well, they've been a plus minus. I kept them as a plus minus, but with some of the recent changes, we might find that interest rates, at least the increases, may slow down. We're going to find that out here pretty soon, and I'll share with you the information on that. But for right now, we've classified that as a plus minus. So it's not a bad economy, even though I know from a policy viewpoint, I think a lot of people are nervous about that. From a leadership viewpoint, I think there's probably lots of questions as to what's going on, and we'll talk more about how the recent events and all of that play together when it comes to looking at the economy and how we go forward. So as always, let's take a moment to review the markets, the S&P 500 and the Dow. Let me minimize this and go to No, that's not the one I want. Come back to that one. This one here. So looking at the Dow in the last, well, you can tell here, this is looking at the last 6 months, but you can tell here in the last few days, the Dow has come back up again. It's broken above the 200-day moving average. We can see that the relative strength indicator is moving back up to that 50 mark. We can see that both the 12, the 26, and the 9 is at flat, but the other two are starting to move back up again. So those are good indications. And again, the daily activity is broken above the 200-day moving average. If we look at that also compared to, say, the S&P 500, we can see that the S&P 500 has done even better yet. It's actually broken through as of today. It broke through the 200-day moving average, broke above it as of today, and now is approaching the 50-day moving average. You'll also note that, as always, we're looking for how the lows are behaving. Each low is getting a little higher, which is a good sign. We've got the highs getting higher, and so consequently, you know, if we were to see some continued movement in this direction, we might see the S&P go higher. Again, though, I know that there's a lot of concerns as to whether or not the U.S. markets and the stock indexes could do that. We'll talk more about what we think that's like here going forward today and over, say, the next 6 to 12 months. Let me minimize this. So going forward, let's talk about what has happened. And I'm not a huge fan on looking back except to see how history has functioned to make sure we don't repeat the same problems again. But in this particular case, just kind of recognizing how things have come together is really sort of central. So some of the points that I want to have you consider is this. One, on March 8th, Silvergate Capital, a central lender to the crypto industry, said that day that it's winding down operations and liquidating its bank. Their stock plunged more than 36% in the after-hours trading. Silvergate served as one of the two main banks for crypto companies, along with New York-based Signature Bank, which that's a name you have heard recently. Silvergate had just over 11 billion, excuse me, 11 billion in assets compared with the 114 billion at Signature. And bankrupt crypto exchange FTX was a major Silvergate customer. So just taking a second there to realize that FTX and their collapse is this is sort of the next domino falling in that process. So FTX collapsed, Silvergate, which was one of their primary account holders, they followed suit and decided to liquidate. Now, they were not shut down, but they did decide to close down operations. 2 days later, on March 10th, Silicon Valley Bank collapsed after customers withdrew $42 billion of deposits the previous day. Silicon Valley Bank was known as a bank that focused on venture capitalists, technology companies, and startups, as well as their owners, officers, and investors. And they had a huge amount of customers that were in the Silicon Valley area that are all in the tech industry and venture capital industry. And so consequently, their collapse was a pretty big deal. And that's why you heard of them and you hadn't maybe heard of Silvergate. Maybe some of you had, but Silvergate was much lesser known. March 10th, customers withdrew $10 billion from Signature Bank, causing regulators to take the bank over on Sunday, March 12th, in order to protect depositors. Signature Bank was known as a bank that focused on cryptocurrency companies and their owners, officers, and investors. They obviously did much more than that, but it was their linkage in the crypto industry, plus their connection with FTX, that probably had a lot of depositors spooked and caused them to take action accordingly. Next, the equities markets have obviously become more volatile as a concern about potential problems with the U.S. banking system have come to the forefront, and that's really what brings us to today. Many people I talked to, and it's not just this last week. I mean, truthfully, it's been certainly since FTX, but it's probably been easily 90 to 120 days prior to that we've had clients who've been concerned about policies and procedures, banking, stock market, the U.S. economy, potential recession in 2023, as we talked about in the previous months. There's been a lot of this, and so this has kind of brought some of this to the forefront and kind of put it at a point of convergence, divergence about ideas and what we need to do next. So that's why I decided to spend most of tonight focused on this to help you make some decisions about where we're going and how to go forward here. So when we take a look at what has happened, we can't really do that without stopping for a moment to recognize bank failures in general, because I think that most of the time we don't really stop and consider what bank failures look like, or we don't. That's why I think when it happens, it's like so surprising to us, as it has been with these last two banks. But since 2001, there have been 563 bank failures. So most of those you'd never heard of. Matter of fact, quite a few of them, my guess is most, if not all of them, you've never heard of, with the possible exception of a few banks maybe in 2008 and 2009. And I apologize, I was trying to make this chart so you could see it. You might have to maximize your screen. If you got a big screen at home, you might be able to see this. But what you'll notice is the red line here. Now, the green line is talking about the dollars that were involved in these failures. The red line is talking about the number of banks. So in 2008, there were 25 banks that failed. In 2009, there was 140 banks that failed. In 2010, there was 157 banks that failed. In 2011, there was 92 banks that failed, 51, 24, 18, and then after that, things kind of got normal. So from that period of time, from 2008 to 2014, we had a very big, challenging financial environment. And from that, we had a lot of different laws were put in place, a lot of different backstops were put in place. As I might remind you that pre-2001, before the economy imploded, 2007, before the economy imploded, there really wasn't a process with the banking industry to have a way to help have the government backstop banks other than FDIC. There wasn't anything that was really available for liquidity for banks. They did have some resources, but it certainly wasn't anything the government thought about. But after 2008, the government began planning a lot differently. And so when the pandemic happened in 2020, the government provided a lot more liquidity. Whether that's a good thing or a bad thing, we can talk about some other time, but that is what happened. And so consequently, in 2020, moving clear over to here, 2020, we had 4 banks that failed. In 2021 and 2022, we had 0 banks that failed. And then so far in 23, we've had 2, guess depends on how you classify Silvergate, or 3 banks that have failed. So the issue is that while I think there's lots of concern about what this means, it's not that it hasn't happened in the past. It's not that we haven't seen something like this, even in the last 2 decades. So again, not trying to downplay this or say this isn't an important issue, it is. But at the same time, more information helps us decide how big of an issue this actually really is for us. So I wanted you to see that information as well. So let's take a look at what this has done to the banking sector as a whole. I'm going to go back now to our charts. And this time what we'll do is we're going to look at US banks. So this is also looking at the last 6 months on the banking. And as you can tell here, we are looking at, this is right here, this is at February of this year. Market's gone down, and that could be just regular. That's not probably much of an overreaction. And then here's March 6th, here's March 7th, I'm sorry, then 8th, then the 9th, then the 10th. So you can tell how this sector has really taken a hit as Silvergate, SVB, and Signature banks fell. And as that happened, you can see there was this area down here is talking about the volume in those stocks. So you can see there was quite a bit of volume, and then the volume kind of subsided, still much higher than normal. But you'll also note that as of today, for instance, it started to move back up again. It tried to move up, went back down, tried to move up. I don't think this is any indication that it's over yet. It's just that it's trying to move its way back up again. And the reason that's happening is that, and I will tell you, I'm in that group too, wondering, is this represent a buy opportunity? I'm not saying that we're going to buy your accounts in it, but I'm thinking about me personally. When you have something that is this far off, then the real question is the US banking system going to collapse? Is it going to be the end of our banking system and our civilization? And unless you think that's the case, you might be like, oh, we better not do anything. But I would say that as a prudent investor, for my own personal money, there's a part of me that wonders if it wouldn't make sense to buy some of this. I don't know that I would do it today or tomorrow, but I would certainly keep an eye on it, because I think, well, unless things are going to fall apart completely, it's probably not a bad group to buy into. I mean, you're looking at going from roughly $500 on this down to $400. So that's roughly a 20% increase if it goes back up just to where it was before. Is this the time? Again, time will tell. But I would say this. I'm looking at 6 months, but let's just go back and look at 20 years in order to get sort of a different perspective on where we really are. So this is the Great Recession. And this is the banking sector, and you can see how low it went. Then this is where it came back up, and it took it, you can see it took it from 2008 to about 2013 to just get back to where it kind of had been before. It took it from about here, from 2008 to approximately 2021 to get back where it was before. And there was some times in there. Here is the pandemic. You can see how the volume jumped up. They weren't tracking volume back here, so this is more standardized volume. Here's volume, and here's the most recent volume of it going, taking a big hit like that. But what you can see is that where this is the pandemic, and here's where we are now, it hasn't even gotten to that position yet. Now, granted, we've got only 2 banks that have failed, and so we had 4 that failed during the pandemic. It probably is, while very concerning still, probably not the terrible concern yet that I think many people are worried that it is. Does that mean we shouldn't be concerned about it or care about it or be conscious of it? Absolutely not. We need to be. That'd just be being prudent. But comparatively, we can see that it's not yet anywhere near where it was at the pandemic, at part of the recovery time, or at the Great Recession. So there are factors here to be thinking about as we look at what this means, both short-term and long-term. Long-term, we're going to have to wait and see more data. But short-term, a week into this, it's not quite as bad as it sort of feels like it is to some people. Let's go back now. So as I just showed you a moment ago, the trailing 20-year numbers, that data shows that we've got a ways to go still. It's not the end, but it doesn't mean it wouldn't get worse, and it doesn't mean it couldn't get significantly worse. It just simply means that it's not as bad, I think, as it initially feels right now, or at least prior to kind of reviewing this information. So now the question is, that's what's happened, but what's happening at this time? And this is where it kind of feeds back into, I think, more of the concerns people have. So first off, a new academic study, and it was put together by 4 economists from different universities, identifies that depending upon certain market conditions, 186 US banks could be vulnerable to the same fate as Silicon Valley Bank. So that's terrifying just in that sentence by itself. Remember that during the Great Recession, 140 happened in 2008, 157 happened in 2009, bank failures. So 186 is a big number. Again, I would point out, it says depending upon certain market conditions. I would also say that the liquidity management that the government does when it comes to how they're handling things now versus what we did in 2008 are different, and that might have some impact. And again, we can talk about whether that modeling that they're doing is good or bad. I think there's a case for both discussions, and I'm going to touch on some of that here in a little bit. But overall, that liquidity that the FDIC and other banks in the system are putting into the system are actually maybe stabilizing things a bit, which kind of gives a bit of peace of mind, at least at this point. On number 2, Point 2, on March 12th, the Federal Reserve Board announced the Bank Term Funding Program, and it was created as an additional source of liquidity against high-quality securities, eliminating an institution's need to quickly sell those securities in times of stress. And what that has to do with, and if you've been reading about this, you already know what I'm about to say, but what happened was, because interest rates were so low, banks were purchasing treasuries at very low interest rates, between 1% and 2%. And so when the Fed raised rates so aggressively here in this last number of months, that created a problem, because those securities they had purchased at 1% to 2% interest could now be purchased at 2% to 4%. And with that in mind, it made it hard for them. It devalued the securities they had. Those securities were still good. It's just the problem is that that devaluation went against their balance sheet, making their banks insolvent. And so they had to find a way to get around that, and they could or couldn't, but with that in mind, it made it so they had to make some decisions, and that problem for Silicon Valley Bank created what ended up with them. And again, we could sit and examine what actually caused all this, what were the policies. That probably won't be as important when it's all said and done, because if there's 186 other banks that are in similar positions, we may find that it's a domino effect rather than just a bank situation on itself. Both Silicon Valley and Signature banks themselves had some very unique aspects of what they were doing, and that caused this to make them maybe the first ones to fall. But looking at just the situation itself, it probably has mostly to do with the rising interest rates and the fact that banks hadn't had to deal with that for a half a dozen years. They had low interest rates, so low yielding assets were fine, and now that's created a problem with interest rates as high as they are. Point number 3, what's happening this time is that FDIC continues to insure accounts up to $250,000 per depositor per FDIC insured bank per ownership category, meaning that if you have a bank account with $250,000 in it, and your spouse has a bank account with $250,000, and then you both have a joint account with $250,000, all three are covered because they represent different ownership. And if you have it in different banks, same thing applies. So having the money broken up into multiple categories also works with that. Number 4, though, which is the thing that kind of has been both problematic and stabilizing at the same time, is that additionally, FDIC insured depositors' bank accounts in excess of $250,000 at both Silicon Valley Bank and Signature Bank, because they decided it could be systematically detrimental to the US banking system if they didn't do so. And again, that has had both a stabilizing effect. It's caused people to say, well, maybe the banks will be okay, but at the same time, it's caused a concern about, well, what happens if 186 banks go? Will you do that with every single bank? Or will you decide that some banks aren't systemically detrimental to the system if you don't do the same for those depositors? Which is then cause people to think, well, maybe I need to be with bigger banks, so that way I will be more protected, which means it could create a problem for community banks, and their system could start to have real challenges. And so it has to do with that point that is both good and bad, and how that's all going to work out is something we're going to watch over the next few weeks and months to determine what that looks like for all of us, including myself. So one of the things, and this is where, and I've debated ever since I put the meeting together, I've debated about whether to show this video or not, but I decided I'm going to show it because I think it kind of speaks to the sort of problem that we're facing right now, which isn't, it's being led in some cases by poor communication, maybe poor thinking about how to communicate, and maybe even poor thinking structurally of what actions to take. So let me play this video. This is a video that was taken just a few days ago. Senator James Langford, honestly not somebody I'm really that impressed with, but I have to say his questioning really pleased me, talking to Janet Yellen about why they decided to backstop SVB depositors beyond 250,000 and Signature Bank depositors beyond 250,000, and what that might mean as he questions it for his community banks and his constituents who are members or depositors of those community banks. What does this mean for them? Now, I'm going to play the video. I could make the video full size, but if I do, you can't read the transcript. So over here on the side is the transcript. If your screen's big enough, you'll be able to read this, but it does share with you the conversation. So if you can't hear it as well, maybe you can read it and see what's being said here. Let me get this started for you.
Over some of the banking issues we're dealing with on it. Will the deposits in every community bank in Oklahoma, regardless of their size, be fully insured now? Are they fully recovered? Every bank, every community bank in Oklahoma, regardless of the size of the deposit, will they get the same treatment that SVBP just got or Signature Bank just got?
A bank only gets that treatment if a majority of the FDIC board, a supermajority of the Fed board, and I, in consultation with the president, determine that the failure to protect uninsured depositors would create systemic risk and significant economic and financial consequences.
So what is your plan?
Made that determination.
Right. So what is your plan to keep large depositors from moving their funds out of community banks into the big banks? We have seen the mergers of banks over the past decade. I'm concerned you're about to accelerate that by encouraging anyone who has a large deposit in a community bank to say, we're not going to make you whole, but if you go to one of our preferred banks, we will make you whole at that point.
So what he's done right there is he's asked a question. I think he has asked a very genuine question that, quite honestly, every senator should be asking about the community banks in their state and their constituents who are depositors to those banks. And he's asked the question, and she's answered that her and a select group of people have decided that certain banks are preferred and need that protection. So the depositors who have millions, tens of millions, hundreds of millions of dollars in those banks, they're all covered. But they haven't committed they're going to do that for other banks yet. And so his question is, well, how do we know that these other community banks are taken care of? And if we don't know that, what's going to stop people from saying, well, I'm just going to move my money to a big bank? Which then questions, well, are you trying to nationalize the banking system? So now her answer to the first part of the question gave some insight into how they made this decision. Her answer to the second part of the question shows how she realizes she's now stepped into something that she should have been more careful about. Let me play that now.
Look, I mean, that's certainly not something that we're encouraging.
That is happening right now.
That is happening because depositors are concerned about the bank failures that have happened and whether or not other banks could also
No,
fail.
it's happening because you're fully insured no matter what the amount is. If you're in a big bank, you're not fully insured if you're in a community bank.
Well, you're not fully insured. And
you were at Signature, and it just barely met that threshold. You were at Signature.
Well, we felt that there was a serious risk.
I want to stop there for a second because her sentence is, we felt that there was a serious risk. I think part of what people are wanting in a moment like this to give us confidence is that it wasn't how we feel. It was more that the metrics, the facts, the information indicated that this should be done and this is how we did it. So if you're not at this threshold, this is how we do it. Not that a supermajority of the Fed, Janet Yellen and President Joe Biden got together and said, okay, we feel this one should be covered. Because part of what that concern leads to is, and maybe it was very valid, maybe exactly what they did made perfect sense. Maybe if you and I were sitting in the room with them, we'd go, yep, I get it, that seems reasonable. On the other hand, there could also be this feeling that, well, what if they just decided they were going to help people who were supportive of them? That Silicon Valley is more supportive of their policies, and Signature Bank in New York is more supportive of their policies, and their depositors are more supportive and more likely to vote for them. What if that's the case? And again, I want to be clear. I'm not saying that's the case because I don't know, but I think that's where what we're hoping for as constituents and as depositors in banks is that we have a group of people who actually are thinking through the facts and legitimately coming to answers that seem reasonable and make sense to all of us, not a two-tier system, but a a justice for all system that protects depositors and banks and businesses and individuals. I think that's what we're looking for, and that's part of where this concern has developed in this question about, is this being well thought out? Is this being managed wisely? And so that's part of what this is about. Let me go ahead and finish out her answer, and then I'll take you to what I want you to see about the rest of it.
Of contagion that could have brought down and triggered runs on many banks. And that's something, given that our judgment is that the banking system overall is safe and sound, depositors should have confidence in the system, and we took these actions.
So there's a special assessment that's been done on community banks in my state and all banks across the country. Was there any discussion that that special assessment would only apply to the larger banks, or was it always assumed the special assessment would cover every bank, including rural banks in my state?
I think I'm not certain what the rules are around that. That's for the FDIC to determine.
It has been reported publicly.
So with that, you can see that it's not that there is a well-defined policy. There are well-defined policies. For instance, one of those well-defined policies is that we know that if we have, what I said a moment ago, less than $250,000 in a bank account, every depositor by ownership and various banks, or all banks, are covered for that amount. But for those individuals that have more than that, that's where they start to say, maybe I should do something different, which is part of the problem that could actually exacerbate this system, this process with the banks, and looking at how the community banks would function. Now, I will also say, and it has been said in several different articles, including something from the Wall Street Journal, that now by doing it this way, the Federal Reserve has sort of set themselves up that if over a certain period of time, a bank falls or collapses, that they may be forced to do the same thing for multiple banks, which you could say, well, that's a good thing, and that stabilizes, and that may well be the case. But then at the same time, it almost encourages dumb decisions by banks, by their boards, to invest in things that are more aggressive because they know they're backstopped and they know their depositors are backstopped. So the reality is that these are complex decisions that need to have solid answers behind them. To be fair, they're only a few days into this, and maybe they'll pull together some better communication about it. But it is one of the reasons so many people are concerned, because they can't figure out, how do I know which one of the banks I'm in? What do I do with that? How do I make decisions going forward? And then if you and I and literally tens of millions of other people are struggling with that decision, do we pull money out of community banks and cause them to collapse faster than they would have, causing some to collapse that wouldn't have at all? And so that's part of what this process is. And that's why, as I said at the beginning, I don't have any great answers yet. I've just got information that we're watching and metrics that we can look at to make decisions how to answer questions as we go forward in the next weeks and months. Let me go ahead here. So as I said to you last time, and one of the reasons I think this is a big concern, and I covered investing in real investments rather than contemporary, meaning traditional versus non-traditional, meaning tangible, more tangible, less intangible. I started with a discussion about money, past, present, future. And I spent time, and if I don't want to spend a whole lot of time on this because we don't have that much time left, but I talked about how money used to be metal. There was a time centuries ago where you would carry around a denomination made of bronze or copper or silver or gold, and that metal had multi-uses. It could be used as a form of currency, but it could also be used to make tools. It could be used to make jewelry. It had multi-use. Because of the challenges of carrying around that much metal, the governments, and I don't mean the US only, I mean all, they said, well, what if we could create paper or some sort of a lighter currency? And so they created paper, and then they backed it by the assets of metal. And then along the way, most governments, United States in the 1960s, but all governments today, they did away with backing it by assets and changed it to a fiat, meaning by fiat of the United States government's ability to tax. That was how they determined value or gave backing to money. So whereas previous generations may have carried around money that was backed by assets, now you and I carry around money that's backed by the full faith and credit of the US government's ability to tax us. But going forward into the future, we might be looking at a digital currency, not just not a fiat, but it would still be fiat unless they decide to back it with something, but a digital. And I talked about how that right now, Bitcoin or Ethereum, for instance, are two examples of digital currency that is a promise backed by a blue sky. Yes, there are rules and the processes that Bitcoin has put in place that says their algorithm can't change the blockchain in such a way so they wouldn't be doubled or anything. But just suppose for a moment if they doubled it, if they said, oh, we don't have, I think it's 23,400,000 units. I could be wrong on that, but we doubled it to 46,000 or 47.2. Suppose they did that. Well, that would mean the value of your Bitcoin would drop, which also is just a clue to why we have inflation, because it would take twice as much Bitcoin to buy something today than it did the day before when it wasn't reduced or when it wasn't doubled in units. The reason we have inflation is because we print so much money. If we were to print double the money today that we have out there, it would cut the value of the dollar. So if we take that inflation thinking with crypto and we say, well, what if the government says we just want to go ahead and offer a digital currency, a central bank digital currency, so that nobody has to carry around dollar bills anymore. And so consequently, you can conduct commerce with this. Then what you'd have is not just paper, not something you could hang on to, but a digital currency backed by the full faith and credit of the government's ability to tax us. Is that an improvement? I don't think so, but I think that's probably something that many people are thinking a lot about. And the reason I point that out is because going to these major banks is one of the big concerns, that if you can nationalize a banking system and make it so it's in the hands of a few banks, it's easier then to create a digital currency that could be managed for a central bank. And that's part of what the concern is for many people. Now, what does that have to do with us today? Well, so I talked last month about the disconnect between your street, Main Street, and Wall Street, and what the differences were in some of those thoughts. But I decided that with this event happening, we'd break it down a little bit further, because what you really have is a disconnect between groups of people. And I could have put way more up here than I just did, but you have a disconnect between, for instance, progressive and conservative political components or policies, procedures. You have a disconnect between how the wealthy function and how the impoverished function. And you have a difference in how the elite and the common function. And depending upon where you see yourself on these various spectrums, plus I could put others up there with all kinds of things, depending upon where you see yourself on these lines has a lot to do with how you are processing what's going on, how I'm processing what's going on. So the disconnect is problematic, and the reason is because it's a lack of trust. We're not sure we trust each other anymore, and maybe for good reason. But at the same time, what we have to do is start identifying where can we trust, what can we trust in when it comes to making decisions, what processes should we be looking at, because in the end, we all still have to work together. And so as we work together, my job is to not let my politics or my belief systems get too much into the mix of my thinking, because I need to figure out what we need to do next to make a good decision. And that's really critical to this, even though I may not have the ideas right now. And again, I've researched lots of resources that we use, and including resources we don't normally use, trying to see if anybody had any great answers. And they don't. It may be like 2008, where it's 5 years later before people figure out exactly what happened. But unfortunately, you and I have to make decisions today. So I wanted to share with you a little bit about how we make decisions in difficult times, because I think you probably do the same. So as Mark Twain said, and you've heard this before, history never repeats itself, but it does often rhyme. And so if we look at some of the past black swan events that have caused us to have these concerns, the Great Depression, the 1970s stagflation, the Great Recession, and then most recently the pandemic. If we look at those events, those are part of the reason that we look at those things and we move that into today and say, what kind of a rhyme is going on here? What's the same? And part of our decision-making process has to recognize that today our culture is significantly different than certainly in the Great Depression. Certainly it's different than the 70s. It's even different, in my opinion, from the Great Recession and the pandemic. I feel like today there's differences that in the way people function and make decisions culturally than what they used to. There are things we talk about today that we wouldn't have talked about pre-pandemic for some reason. Politics are different. Politics, you might like one side of the aisle or another. You might have distrust for both right now. Philosophical disparities. There's a lot when it comes to philosophy. Some of the issues with the hot buttons of today with ESG and BLM and CRT, and so some of those things out there that are causing real disparity in how people think. Corporatism, the way that some of the corporations seem to have sort of taken over since the pandemic, and some of those issues. And then finally, governmental finance, which I referenced earlier, is different today than it was back in the 70s with stagflation, the Great Recession. It's now different than what it was there. We saw some of that work itself well in the pandemic, but we also saw some of the problems that came from it. So all of these pieces come together and force us to have to make decisions in difficult times with less information than we'd like. We'd like to be able to go back and go, oh, this is just like the Great Depression, or this is just like stagflation, because we could then figure out exactly what we should do next. But there's other factors messing with us on that. So when you kind of look at this tree, I would say that there's knowledge or information, there's understanding, and there's wisdom. Information, in my opinion, is knowledge obtained from investigation, study, or instruction. And it's a lot of what I've been doing this last week as I've tried to put together today's program. Understanding is comprehending a subject or a situation or about how something works, to be able to take that knowledge, that information, and move it into something that's a workable model. There's a lot of people that have information. We all carry around these little devices now that make it so we have lots of information. Understanding, there's less people that have understanding. Many people just kind of blunder along, but there are some people that have understanding. I'm sure you do. I try to have understanding. But wisdom is the ability to contemplate and act productively using knowledge, experience, understanding, common sense, and insight. Maybe if I were to put that this way, it's the ability for me to think through, well, so the common people need this part and the elite need this part. Conservatives need this part and progressives need this part, and the impoverished need this and the wealthy need that. And trying to think through as a leader, not that I'm a leader politically, but to think through as a leader, how do you put these pieces together to bring the best result for the widest swath of humanity? Another way I would express this is this. One of my mentors showed me this, and I have to say I love it. Imagine that there is a circle of knowledge, a universe of knowledge, and everything inside that blue box is the total combined knowledge of everybody on the planet, everything that we have. There are some pieces of that knowledge that I know to be true. I am certain it's true. And then there are some pieces that I don't know anything about. For instance, I know that brain surgery exists, that I know to be true, but I don't know anything about brain surgery. I'd be useless there. So there are pieces of information that I know to be true, things that I have to acknowledge I know something about, but I don't really know anything about it. Then everything else is in my blind spot. Everything else is stuff that I do not know. That's why getting more information is critical to making wise decisions. With that, the only way to expand my universe of knowledge or to close off my blind spot is the places I go or experiences, the things I read, personal study, and the people I meet, transferred knowledge. Those are how I expand that. When I do that, what happens is I learn a few new things. There's some things that I knew to be true that I found out weren't true. I was certain they were, but I found out some things that caused me to go, okay, maybe I need to rethink that. There's also areas of my blind spot that open up that I get new information on. So having the ability to look at a process and say what goes on next, what goes on after that, what goes on after that is part of that process. And along with that, I will then be able to do more and accomplish more and make better decisions, even though occasionally I'm going to make some wrong decisions. We all do that. And I probably make more wrong than I do right. I know every time I say that, people around me cringe. They're like, you're not supposed to say that. Well, it's true. If I could get it right every single time, that'd be amazing, but none of us can. So what we try to do is to make the best decision we can and then leave ourselves either safety nets or parachutes to protect us in the process to minimize any damage with that. So with that in mind, what we try to do, all of us, is make the best decisions in difficult times, and that's what this is. And so to panic or to worry about it makes it harder to make a good decision, but to get our information together, to have good relationships with people we can trust, to be able to experience and then learn from it and grow and change, that's what this is about. So now, what do we want to watch in the future? Well, there's a number of reports that we get. This one just came out on March 15th, so I used it. I've got more that will be coming out, but this one came out, so I thought, well, I'm going to use this as a way to show you what some of our resources, trusted resources we pull information from, tell us they think is going to happen. And they, on the next page, they talk about some things, and they include what happened with Silicon Valley Bank and the problems potentially for that. So, but here's the numbers, their revised numbers on what they think is going to happen. So their anticipation is we'll have GDP growth of 1% this year, this quarter. That's their anticipation. So that would mean we'd have a positive quarter. Don't know if that's true. The data kind of makes me think it's not far off, but we'll find out. They expect that the next 3 quarters will have under 1% negative growth or decline, almost 2% negative decline, less than 1%, but more than 0.5% decline in the 4th quarter, then start moving back into positive quarters again. That's what their data and all the resources they put together look at and say. Now, will they agree with every other report we're going to get? No, but they might. They're not going to be far off because they have typically been in the same range as most of the resources we look at. Now, when I say we look at these resources, we try to find groups that disagree with us and groups or disagree with me, and I try to find groups that agree with me because I'm trying to get a fair view of what's going on, a good perception. They look at real GDP year over year. We can see that it stays positive even though it's going negative. Year over year though, then it goes negative, then it's negative here because of the previous quarters, and then it goes positive again. Unemployment rate, they expect unemployment rates to stay relatively low, but they do think that by the time we get to the 3rd quarter of the recession, that probably will start to go up, hold, and then maybe come back down. They expect for inflation, core PCE inflation, 4.5, 4.2, 3.7, 3.1. Remember, the Fed wants a target of 2. That's what they're always shooting for. So they're still above it. It's elusive to them. They can't get to what they want. They do get closer, and then finally, by the end of next year, assuming all this data holds, they would be there. Again, I'm not suggesting they're going to be there. I'm not telling you this is guaranteed. Matter of fact, this is forward-looking, and you know as well as I do, we all have things that pop up economically. We don't know what's going to happen with Ukraine and all these other issues. We don't know what's going to happen if there's going to be a lot of bank collapses or just a handful. All these things can change. But as of the data we have today, this is what the forward-looking component looks like. And then this is what the interest rates look like. The anticipation is that the Fed will probably slow down its interest rate increase because it may have been sort of part of the reason why SVB and Signature collapsed, because they had this rush to increase interest rates. And then we see that it should start to come back down again. Again, these represent some of the metrics we're going to be looking at to determine what's going on. Some of it is forward-looking, some of it we can tell more quickly, but these are the pieces that cause us to look at not just the technicals of the market, but also economic data that helps us think through what's going on. Let's see what time it is. Okay, I'm not doing too bad here. So here's sort of the summary of what that report said. I tried to break it down as much as I could. Economic weakness will intensify and spread more widely through the U.S. economy over the coming months, leading to a recession starting mid-2023. Outlook is associated with persistent inflation and the Federal Reserve's hawkishness to raise interest rates. Real GDP growth will slow to 0.7 and then rise to 0.9 in 2024. U.S. economy, especially U.S. consumer, has resisted these headwinds, but they think that it's going to probably catch up a little bit here. Because of this increase, or because of this information, they're increasing their forecast for Q1 to 1%. U.S. economy will slip into recession. We just talked about that. They identify here the recent collapse of Silicon Valley Bank and several other smaller banks has triggered alarms about the financial stability in the United States. And they don't think the risk is immaterial, They don't think it's immaterial, but they also want to make sure they stay on top of it because they don't really think it's a contagion that's going to spread more broadly throughout the banking system. Again, they don't put any numbers on that, so we don't know what that means. I think, if we were to have 10 more bank collapses or 20, that probably wouldn't be something they would panic about. If we started to get to bigger the number than that, that might be a little more concerning. Not that we want any bank to collapse, but I think that's probably how they read this. They don't expect the Fed to stop raising interest rates, but they do expect them to slow down to 25 basis points. That's going to be here in the next few days, so we'll be able to tell from there what's going on. They believe the Fed's going to slow down at 5.25 to 5.5 and not probably increase much above that. They think inflation is going to cool over the course of 2023, but it's still going to miss the Fed's 2% mark. And they expect that the Fed will not cut interest rates until probably next year, which would be an indication the economy was strengthening. That would be a good thing. So is this what's going to happen? Again, nobody knows, but I can tell you from the data that they, plus other reports we look at, this is what they indicate this is what they see the data moving in direction, trying to identify best case, worst case, and most likely scenarios. So how do we invest in these challenging environments? Well, as I shared with you last month, we really work to try to get to more tangible kind of investment ideas that are less subject to the volatility that comes with contemporary assets. And so we've brought in a number of new pieces. We've talked about how we are working with more business interests, because I kind of feel like equities, even though I've been doing this for over 3 decades, and equities have been a great resource for us. It just feels like they're more like billows in the wind anymore. You got 6,500 companies out of 2 million that we can buy ownership into them. We've been working to try to be able to get into some of these other companies that are not publicly traded but privately held, and we've made some real nice avenues into those, and we've got a number of you who are using that. If you want more conversation about that, I'd be happy to do that. Another thing we've been working with is looking at ways to use various notes and CDs to create higher than average interest rates and to create securities that can give us some better than average income with some great stability, better than sort of the volatility of the markets. So we've worked on those as well, and several of you are using those. We're going to be introducing more of that. Last year we spent a whole part of the year looking at how to add these into our system, and we did that in the 4th quarter of last year. And if you'd like to talk more about that, because maybe some of you haven't heard this story yet, please reach out to us after the webinar. I'll be happy to get with you and show you how we're putting these programs together, because they do represent some very interesting ideas that we feel have some risk to them, but not the kind of risk that we see with the volatility of the market. So we can talk about that and see what kind of thoughts you have on that as well. So we're trying to pick items that we think are more tangible, that we think have better opportunities, that we think have the ability to withstand instability and volatility better. And so those are some of the pieces we're bringing to the table now. And then, as always, we still do the standard stuff with trying to pick and choose indexes and stocks and various balancing of portfolios through asset allocation to make sure that we can withstand up and down times in the market, as it says down there at the bottom, proactive wherever possible, reactive whenever necessary. And so there's a lot of things out there that we can look at, and that's where my last webinar, the advisory review, was designed to sort of help you get to think about some of the things that we're thinking about. So some final thoughts here for you with all of this, because again, while we don't have great perfect answers, I will tell you these are some things I would think about. 1, confirm that your bank accounts, value, and titling are covered by FDIC. If you have an account and it's more than $250,000, look at either diversifying that, not diversifying, changing the title, like get part of it moved to another account under different titling. Talk with your bank about that. That may help a lot. If you have too much and you cannot do that, then maybe you could take a look at how you might shift to various banks to help make that work. And again, please understand, I don't want you to do a run on the community banks. I don't think that would be good for any of us, but I also want you to be safe. So look at the value of your accounts, look at the titling of them, and then decide how that fits. And if you have questions about that, give us a call. I'll be happy to talk with you about that and give you some insight. Number two, if you have concerns about your bank, if you're worried that your bank might be problematic, review your concerns with them to make an informed decision. Ask them for their last fiscal reports. They should give those to you, and they will tell you what's going on. And if you feel like that may not be enough information, talk with some other people around them to see what they think. And again, we're here for you too on that to answer questions about whether or not you should stay with your current bank or not. Again, I'm not sounding an alarm that things are terrible. I think it's just that we want to be careful, and nobody wants to have a problem with their bank as a depositor trying to get FDIC to give them their money back. So while I don't think that's an issue for probably most of us on the call, if not all of us on this call, I would say if you have concerns, let's talk about it. Number three, review your investment strategies to confirm that your portfolio is meeting your needs. Liquidity, you got cash reserve. Income, you get the income you need from your portfolio. Flexibility to make changes if things go south, want to be able to make adjustments quickly. Growth to meet your future needs, and that your risk is matching your risk tolerance. Again, some of you have investments outside of us. We'll be happy to review those with you as well. But certainly if you have questions, anything we're doing, please feel free to give us a call. I'd love to talk with you about it. Number four, stay vigilant over the coming weeks and months about changes happening in the US and world economies and markets. I know it's too much information. You just go crazy listening to all of it. But listen, and if something pops up that catches your attention, make note of it. And if you have a question, certainly reach out to us. We'll be happy to answer those with you. But we're watching it, and since we're partners in managing your wealth wisely, let us know if you find something that you have questions about. And then finally, number five, ask questions. There are no dumb questions. I know we've all heard that our entire life, but at times like this, ask questions. There are no dumb questions. Every question, while there may not be the answer you want, or maybe there's not full information for that answer, it's a good question to ask. And if it helps get you some confidence in where you're going, or to give you better information to make adjustments, that's what's critical. And number six, join us for our next investor advisory review, because we're going to keep updating this and staying on top of it with you and for you. So those are the final thoughts I have about that. Just as a quick reminder, when it comes to planning, creating, growing, protecting, and preserving wealth, we believe that fiduciary wealth advisory requires a vigorous financial planning strategy, because it's not just managing money in good times or in protecting it in bad times. It's making sure that you've got a plan to maximize what you're trying to do to accomplish creating, growing, protecting, and preserving wealth for you and your family, and even multiple generations in some cases. And a good strategy for that is to have a financial plan that shows you the direction you're headed in, and determine whether that's short term, the next few years, or long term till you assume room temperature. This is the way to make that decision, to have a good plan in place for that. The three phases of your financial journey for all of us is pre-retirement or accumulation phase. We go into post-retirement or decumulation phase, and then finally we transfer these assets on. And the fiduciary wealth strategy should be able to help you look at all three areas to make sure that you're going to achieve your desired return on life. And that's why we take the time to build this way. These are the resources. I tell you about it every meeting, so I don't have to spend a lot of time, but you can go to your financial dashboard. You can go to our website, hit the login button at the top right, then it'll bring you to this page, and you can log into your financial dashboard, your portfolio dashboard, which is the assets you have directly with us, your risk reward evaluation if you want to reassess if your risk tolerance is what you think it is, and then your financial life plan, which is how you can attach the feelings and the things you want to achieve to the facts and figures of where you are. These are there, and we provide them for you. Please use them. So now with questions. If you've got any questions, we are going to take time to answer them. I have got 1 minute left, although I'll go a little bit longer if you want. There was one question that somebody emailed me on. Simon asked me if, and I didn't have a chance to get back to him, so I thought I'd just put it with this here. If I thought that the real estate market was going to change dynamically because of this. I think, first of all, it has changed a bit. I don't think we're seeing it as much in Florida, but I think it has changed in other places. We work with a number of firms that do real estate investing, commercial, multifamily, single family, storage, leisure. And we're hearing from different quadrants, especially in different locales, that there is some changes that are happening. Certainly some, Wells Fargo, I believe, is the one who put a moratorium on loaning money, mortgages for a period of time. So we're seeing some of that now. Do I think it's going to happen here in Florida? I don't know. For those of you who are outside of Florida, I think it's kind of a more of a regional question, which we can talk about. But I would say yes, there's going to be something. How much, how much it's going to be will depend upon how deep and long the recession is. If we are going to have a recession, which I think is reasonable, if it's a deep and long one, obviously that's going to have a much bigger impact on the real estate market. But I think, quite honestly, that means there's going to be some opportunities for those who have cash or capital available to buy into it, which wouldn't be a bad thing, because I think real estate is one of those 8 asset groups that we have great confidence in their ability to meet needs. Do you have resources for or have a list of the 186 vulnerable banks? Great question. I did not pull that up. It is something that we can find. Actually, I found the list, although I will say that I'm thinking right now, I'm not sure if they published the list or they just put together the components of the list. But Jill, if you want, I'll take a look and see and reach out to you tomorrow and let you know if we can get a hold of that list for you. That's a great question, but I don't know that we have that information. I also kind of wonder if it wouldn't be just a little problematic to put that out, because it could get some people sued. So not meaning me, but the academics who put the study together. So I don't know. Oh, you're welcome. As always, you're welcome. All right. I don't see any other questions. I will just update you on a couple of points here, and then we will, if there's any more questions, I'll get that before I leave. Our next update is April 18th. We will have our monthly investor advisory review then. I did add this time that if something new or critical becomes available, information, and it results in significant economic or market changes, we will offer an investor update prior to that. I won't wait until April to get that done. If nothing really changes, then we'll do our April 18th. But if anything that I think is problematic or important comes up, and I feel like it's worth it, we will definitely do an emergency investor advisory review. So we will do that. So here we go in review. We took time to review the market and the economy as much as we could. We talked about the impact of SVB and Signature Banks, their collapses here on the US banking system. Hopefully, I know I didn't get to spend nearly as much time as I wanted to on strategies for creating, growing, protecting, and preserving wealth. If you have more questions on some of the new things that we've got going, you just want to make sure you're up to date on that, please give us a call. We can schedule time. I'd be happy to talk with you about that. Please use our resources from the website to help you manage wealth wisely for you and your family. I gave you the final thoughts I had, and hopefully that gave you some confidence or direction. Next time, if I have more, I'll be happy to share that as well. Answer the questions, and then I remind you of the next advisory review. So hopefully this is giving you some of what you need. I know we have a bigger than average group on here, so hopefully that's helping some people. As always, if you'd like to invite your friends to these reviews, you are welcome to do so. Just let Kayla know, and she'll send a special invitation to them. And we would be happy to have them on here. And again, if you have any other questions, I don't see any right now, but if you have any after the webinar or anything you want to talk with me about, please reach out, let us know. We're here for you, as always. Again, even putting this together tonight, I was a little nervous to do it, to be honest with you, because I don't like to walk in and not have great ready answers to go. But I felt like this would be helpful, and so hopefully it was. I do appreciate you so much. In the last couple of days, I've had a number of great conversations with clients, and it just reminds me how much I am appreciative of your trust in me and honored by our relationship. So please know that I appreciate you and think of you often, and always working to figure out how to help you get done what you want to accomplish. So I hope you have a wonderful evening and a great week, and hopefully we're gonna have some really good news in April to talk about, and I will look forward to talking to you then. So have a wonderful evening. God bless.